Hey everybody, this is Jose. We are about to start in around 40 seconds. This is a sound check, so please go ahead and give me a quick message on the chat box just to confirm that you hear my voice. That would be great, so I know we are ready to start. Anything we do, just a quick hello, that would be good enough. Sound is good, perfect. Okay, so everyone, we are now ready to start. So let me maximize our introduction slide as always, so we can introduce the session formally and begin. Hello everyone, today is August 31st, 2019. My name is Jose Blasco, I will be your guide. And today I'm guiding you in the world of sharpening our skills. So today we're gonna be talking about futures markets. We're going to be looking at many different types of futures markets. We've been focusing in our intraday trading sessions on S&P and NASDAQ, which are equity indices. Today we're going to go ahead and discover more options that are available out there when it comes to futures markets and get to understand those different options so you know which one to use in your own trading given the characteristics of the trading you want for yourself. And things such as the time of the day at which you trade, things like that. Okay, and so again, we're gonna have a little bit of let's call it a tour to get to understand all those different markets and their characteristics, because obviously trading the right markets will give you an advantage, where trading the wrong markets may give you a problem. And the fact is that many times traders around the world, they end up trading certain markets just because someone said that that market is good, and maybe it's good, but it may not be good for you, or maybe it is, okay? And the idea is to measure what good means in ways that are objectively quantifiable, so you can decide for yourself which market should you trade, not only today, but as time passes, because as time passes, many things change, isn't it? So there are markets that go from very slow pace to very volatile. There are markets that go from very liquid to not liquid and vice versa. So things change, and as traders we need to be able to measure, quantify, and be adaptable. So that's the plan for today, okay? Before we start, we have a disclaimer as always, so I'll do this very quickly. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And this would conclude the introduction for the session. So let's begin, okay? And notice that today, the way I am beginning the session, and it's good to see you all guys, Geneva, Frank, Eric, Al, everyone, pleasure to have you here on the Saturday session, isn't it? And I was saying that the way I would like to introduce the session today, it's just bringing something that you already know, which is our collection of edge timeframes that we use for the different markets, right? Because in this particular page, we actually have a summary of the most important futures markets here on the right side. Sorry, on the left side of the page. Actually, on the right side we have them too. Okay, we have a collection of all the key futures markets, which, by the way, today we're going to be talking about many of those. Okay, so let's begin exploring first these different markets. Okay, and notice how we have on the top the ES, okay, the NQ, the YM, and the RTY. So those four markets are, sorry for that, I just went with the wrong drawing tool. Those four markets, okay, represent equity indices, okay? So indices made of equities is what those markets represent. And to be more specific, the S&P, probably you know this because we have been using those for a long time in the sessions, right? So this would be the S&P 500. The NQ, okay, the NQ, that one is the NASDAQ, okay, and here I'm going to have a little bit of overlapping on the text, but it's okay. Then the YM, that would be the Dow Jones Industrial Average, okay, which is made of 30 stock. And finally, the RTY, the R stands for Russell, which is the Russell 2000 index, which is an average calculation that represents the average performance of 2000 small capitalization stocks, okay? So all those markets that we have in here are equity index markets. And there is something important for us to understand when it comes to those markets, because we are dealing with futures, okay? That's how I introduced the session by saying that today we're talking about futures. So futures markets, you need to understand that those markets were created to have a guaranteed delivery in a future date at a specific price. So these markets were designed, for example, if a corn buyer wanted to purchase corn at a specific price, that corn buyer would have a specific deal with a corn seller where they would sign a futures contract. And it's called futures because that corn buyer would receive delivery of corn in a future date. But even though the delivery would be in a future date, the price was set when that contract was signed, and the corn buyer would oblige himself to purchase corn at that price in the future date, where the future seller, the seller of the futures contract, would oblige himself to sell corn in that future date at that specific price. Okay, and that was an agreement. That's why when we trade futures, we trade contracts. Contracts is another word to say agreement, isn't it? And that's what it represents. But here's the problem with the equity indices, okay, which again, it's not a problem at all for us as traders, but if you allow me to use the word problem for a minute. So what's the problem with the equity indices? Well, the equity indices are not deliverable, okay? They are indices. And what is an index? An index is a mathematical calculation that represents the average performance of a collection of stocks. For example, the S&P 500 is 500 stocks, where you would take their performance, add it up, and then divide it by 500, and you end up with the average. Okay, so that's a mathematical calculation, which is very smart, but is not deliverable. Okay, so those 4 equity indices, okay, the first thing that you need to know is that they are cash settled. Okay, so what does that mean, that they are cash settled? Okay, they are cash settled. So what does that mean? It means that if you were to buy a futures contract, okay, and I'm going to be a little dramatic here, follow me please. Let's say you were to buy long a futures contract for the S&P 500 that we normally call the ES. And let's say you didn't use a stop and a target. So you just bought the contract and you close your eyes, which is something that we never do. But let's say you did. And then you got in the car or you went to the gym and you had an accident. And you broke your leg so bad that then you went to hospital. And you spent a few days in the hospital, and expiration for the contract happens while you are in the hospital and you didn't have access to your computer to close the trade. So what would happen? The moment you would get to that future date, which is the expiration date, you would then be obliged to take delivery of that contract. Okay? And if you had traded in such a reckless manner with no stops and targets, then you would have to acquire that product, okay? But what happens with the equity indices? You cannot acquire an index because it's not deliverable. So what would happen? Those futures contracts would be cash settled, and you would get to see the effect of the P&L. You would see that reflected in your account. So for example, if you purchase that contract and the market went up, then you would see an automatic profit appear in your account on the expiration date. If the S&P went against you, then you would see an automatic loss appear in your account automatically, but you will not get delivery of anything because those indices are cash settled. In other words, it's quite safe. Okay, it's quite safe, and this is one of the reasons why in our practice during these few months we have been practicing with the S&P and the Nasdaq. First, they are very liquid markets, which adds safety to what we do, but also the fact that they are cash settled give you certain guarantee that, let's say you went into this accident in the gym and you end up in the hospital and then you reach the expiration date. Well, if that was a contract that was actually deliverable, then not only you got you are now owning, for example, if you did this with crude oil, so you are now owning real crude oil. Okay, not only that, on top of that, while you stay in the hospital, the price of crude oil keeps moving. and you may end up in a further deeper pain, where when you trade contracts that are cash settled, well, the end of the story is the day of the expiration, okay? And please, 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 of course, I am not suggesting to take a trade and close your eyes and hope for the best. We always manage our trades with risk management, setting stops. We always use stops. We also set targets. So we always manage our trades professionally. But if you were to ever do something like that, where, you know, something crazy has happened and you had no control over it, well, the beauty of the 4 initial markets that we have on the top is that being cash settled, somehow you have an extra limitation of whatever damage may happen, okay? Now, we will need to talk about margin as well and things like that, because of course, cash settled, even though I just said you may have a limitation of damage, well, you may still get a margin call, you may still get certain problems, given the fact that you didn't close the trade when it was the right time, okay? So please, please, please never do that. But I'm just talking about it from a theoretical point of view of what would be your worst case situation. If you were to hold a contract into expiration date, okay, then you would be obliged to take delivery of that product. Okay, and again, I'm repeating myself. The beauty of the 4 equity indices that we deal with, S&P, Nasdaq, Dow Jones, and Russell, is that being cash settled, you would never take that delivery. Okay, and therefore you have a little bit of a damage limitation when it comes to what could have happened. Over a little bit of a tour of all those different markets, and then we'll get into specifics that impact directly which ones you want to trade and why. But first, let me introduce you to them, because you may know them all, you may not know them all, okay? Please go ahead and give me a little bit of a confirmation on the chat box. If you guys are following well, please, just say it. And if I'm going too fast, make sure you let me know as well. Please give me some confirmation, even if you just want to say that it's okay. The next group that we have here is treasuries. Okay, so the first group was equity indices. The second group is treasuries. Okay, and treasuries could be treasury notes. Treasuries could be bonds. It could be credit products. This is what this group is all about. Okay, and again, there are many markets that reflect that in the world. Obviously, in our table, we have the most liquid, the biggest markets in the world, and therefore the ones that we are dealing with here is the TY, okay, which T stands for 10, Y for year. So this is the 10-year note. Then we have the FV, which F and V stands for 5. So it's the 5-year note. And then we have the US, okay, which in this case it represents US bonds, and the classical expiration for the biggest bond market in America is 30-year expiration. So this is 30-year bonds, 5-year treasury notes, and 10-year treasury notes. Okay, those are the most liquid ones. Okay, Gabriel, how are you? It's a pleasure to see you here, my friend. So so again, these are the most liquid ones. Okay, there are more. Okay, you have the 2-year treasury notes, for example. Okay, so there are more, but they are much less liquid, and therefore those would typically be your bread and butter. Okay, the next group that we have here, okay, is CL, GC, NG, HG, SI. Okay, and CL stands for crude oil. Okay. So you may want to remember the C for crude, which is how we often call it. We often call it oil or crude. Okay, and that's the one we use. There are other oils. Okay, you have Brent. So there are other combinations. You have other products derived from the same base components, such as gasoline, which you also have gasoline futures markets. But again, liquidity is much less, so that's why we don't have it in the list. Okay, so crude oil and natural gas, NG. Those are what we call energy markets. Okay, so in this group in the middle, we have energies, okay, and metals. Okay, those are the groups that we are dealing with here in this particular section. Okay, so CL and NG are the energies, and then we got GC. Of course, the easy one to remember is the G for gold, so it's the gold contract, GC. Then we have HG, which is if you know chemistry, this is the symbol for copper in the in the elements table. Okay, so HG, that would be copper, and then SI for silver. Okay, so again, quite easy to remember. If you never traded those markets, it will take you no time to remember the symbols. Okay, quite simple. Okay, so those are energies and metals. Okay, and you know, if you think about it, energies and metals, in one hand they got nothing to do, but in the other hand, both will share some characteristics, as you will see later on, especially when it comes to volatility. Okay, so I'm not sure why many exchanges around the world they like to pair energies and metal together, and they call it one group, energies and metals. Okay, they are different animals, obviously, but at the same time somehow they are related because of those reasons. Okay, so energies and metals, you know, you may want to think about it in the same group. Okay, the next group that we have here, okay, is currencies. Okay, so all this group that we have here is the currency futures. Okay, so you may want to call them either currency futures, okay, or you can also call them FX futures. Okay, it's common to call them the same way. Okay, they're both ways, FX futures or currency futures. And again, starting from the top, EC, you're probably guessing it. Okay, it's the euro contract. So E for euro, C for contract. Now, for the forex traders out there, I need to talk about what's the difference between trading spot forex and trading currency futures, which I will discuss a little later. But the first thing that you need to understand is that every time, if you remember when we talked about forex, every time you were trading spot forex, okay, what you were trading was not a currency. What you were trading is actually what we call a pair. Okay, for example, the euro against the US dollar. Okay, and we call this the euro US dollar pair, which very often we just call it the euro. Okay, well, in futures, okay, even though you know there is always two currencies involved in the trade, we normally never call it two currencies. The denomination, okay, the naming nomenclature for those markets is normally one currency. For example, the euro contract. So what does that mean? Well, it means that, you know, you need to go into looking at the contract specifications, okay, which are set by the exchanges, and then you will know which currency they are traded in. Okay, well, when you look at the contract specifications for the euro contract, you would see that what is known as a tick, okay, a tick, okay, in the euro, for example, and I will show you a table later on that summarizes all the tick values, okay. By the way, in spot forex, we would not call it tick, we would call it pip, isn't it? So in futures, it's called a tick, okay? So the tick value, okay, for the euro is $6.25, $6.25 every 0.00005, okay, which is a tick, okay? Every movement that, if you think about it, this is half of a pip in spot forex, okay? A pip in spot forex is 0.0001, is the fourth decimal. So in futures, instead of the fourth decimal, we have price movement in the fifth decimal place, but it's only 0.00005 at the time. Okay, so it cannot go to 0007 or 009. It goes to 0.00005 or then changes to the next digit to be 1. Okay, so that minimum price movement known as a tick is worth $6.25 for the euro. And here's the key. What currency did I just mention? I said dollar. So in other words, when you trade the euro contract, okay, every profit or loss you make is measured in US dollars. What does that tell you? Well, it tells you that the euro contract in futures is exactly the same market, represents exactly the same market as the euro USD, even though we don't have the naming USD in the name of the contract. We only call it the euro contract, but the fact is that you got USD behind the scenes. So this is equivalent to the euro USD. Just like the next one, GY, you are probably guessing it is for the Japanese yen. So it's not Japanese yen against, Turkish lira. It's Japanese yen against US dollar. Okay. The BP, which stands for British pound, okay, is not British pound against Canadian dollar. It's British pound against the US dollar again. Okay. So even though it doesn't say, all those currency are against the USD. Australian dollar, AD, Canadian dollar, CD, Swiss franc, SF, all those currencies are traded against the US dollar, like if it was spot Forex, but in spot Forex, you can see it as part of the symbol, where in futures, you don't see it as part of the symbol, but the US dollar is behind the scenes, okay? And by the way, good to see you, Subhash. And by the way, they are what in spot Forex is known as cross pairs, okay? They are cross pairs. You're right, Geneva, I see your question right now. Those are all majors. You're 100% right. They are also cross pairs in futures, but just forget about them because they have miserable liquidity. Like not only low liquidity, is miserable. So they do exist. A few currencies that are cross pairs do exist, meaning that there is no US dollar involved. For example, the euro yen does exist, but the liquidity is so terrible that we would never trade them for speculation purposes. Different stories that you need to hedge a trade, or you work for a company and you are dealing with euros against yen and you want to hedge or something like that, and you don't want to be exposed to interest rates and you end up using a futures contract. So, why not? But it has nothing to do with what we do as traders, trading for intraday, trying to capture a move and profit from the move. We need liquidity to do that. And, in the group of currency futures, we will only find liquidity in those majors. And by the way, not even all of them, some of them are quite disappointing, okay? Quite disappointing, okay? As you will see in a minute, okay? What else do we have? The last group here in the bottom, okay? This is kind of like, I mixed a few groups as well, just like earlier we had energies and metals, okay? So here we have agricultural products. So agricultural products, we have grains, we have meats, we have softs. So, it's all mixed up here, okay? But let's call it agricultural, just to keep it simple, even though it's not all exactly agricultural. So C is for corn, S is for soybeans, W is for wheat, that's agricultural, okay? SB, that's for sugar. So, somehow comes from the agriculture, but it's a processed product, so it's a different story. KC, that's for coffee. Okay, again, yes, it's come from agriculture, but it's another processed product. Live cattle, live cattle may eat some agricultural products, but they are animals. They are not, agricultural purely anymore. Lean hogs, which is LH, okay, again, animals, okay, may eat agricultural products, but again, not exactly the same. CC, that would be for, oh my God, I just lost it right now. CC, can you believe this? I just got confused now. Okay, I'll tell you later, guys. I just got a empty spot in my mind right now, and CT is for cotton. By the way, if you remember what CC is, please type it, because this is so silly. I for whatever reason it's not clicking right now. It's the bad habits you develop sometimes with TradeStation, where you put the symbols in the radar screen and you just click, and somehow it's a healthy thing, because a chart is a chart and you don't want to care about what the market is, because Coco, thank you so much, Gabriel, thank you so much. It goes with coffee, okay? That's how you get your cappuccino. Anyway, in the end, and this is a point I wanted to make, it's important for us as futures traders, okay? In one hand, now that I gave you a little bit of an introduction of all those different products and groups, in one hand, we need to know their specific characteristics, because those specific characteristics will either tell you that you want to trade them, or they will tell you that you want to pass. But in the other hand, once you decide that you want to trade markets, okay, it could be cocoa, it could be Australian dollar, it doesn't matter. In the end, a chart is a chart, and the way you plan trades should not be biased in any way, right? So maybe you have a family member that have a food business, and you wish the price of cocoa to go down. This should not impact your trading decisions. You need to trade based on a methodology, no matter what the product is. Okay, so somehow I'm almost almost glad, and certainly not for this session from a sharpening point of view and helping you with educating you in this case, but I'm almost glad for myself as a trader that I even care what the symbol is, because a chart is a chart. The only thing I care about is the characteristics of the product behind the scenes, okay? So anyway, first thing that we did in this beginning part of the session today is to get to understand the different products available. And by the way, there are many more. If you were to do a little bit of research, yes, I will talk about the micros, Frank, you're right. So if you were to do a little bit of research of certain products available out there in the futures markets, in different exchanges around the world, you're going to go crazy on how many futures markets exist in the world. And some of them are really, really, really original, okay? And I'm not talking about futures on cryptocurrencies, okay, which you could trade that too. I'm actually trading about things such as futures on weather, okay? So you got weather products, okay? You could have a bet that you expect the weather, to go in certain direction and have a trade in the futures markets. Okay, now these products could be very, very useful for farmers that may have a problem with the weather or expect a problem with the weather, and they want to have a bet on the weather to hedge their crops. That could make sense, okay? But again, those products are not liquid for us intraday traders to go ahead and take advantage of them, okay? So basically, the list that we have in front of us is the most liquid list of futures markets. It's probably the most relevant list in the world, and it's probably the one that will be your bread and butter. And by the way, probably not even all of them is probably too much, okay? So I'll show you in a minute the markets that I focus the most on. And by the way, you will see as well that based on their liquidities, there will be times where I will only go for time frames that are a little larger, and there will be times where I'm okay to go for lesser time frames, and it's all about the liquidity I would find, okay? So you will see that in a few minutes from now as I go deeper into all of this, okay? But the first thing was to get you introduced to all the different groups in futures, which are, one more time, indices, treasuries, energies, metals, currencies, and agricultural, okay? These would be all the possibilities out there, okay? So knowing this, so what I need to do, and I'm gonna bring a spreadsheet to do this, okay? So what I need to do now, okay, let me make this a little bit bigger size so everybody will see better. So what we need to do now is for every one of those futures products, okay? So we call them products. So for every one of those products, okay, which again, we talked about, we have the ES, for example, right? We have the NQ, right? Et cetera, et cetera. For every one of those products, so there will be some characteristics, okay, that will make them valid or not for us to trade them. And I want to use a spreadsheet to explain it and go over it manually with you so you get the point. And then I will put it in a way that is a little more automated on a radar screen. So then you have kind of like on an easy way in a daily basis to have a decision matrix, if you wish, where you have an easy time to decide which markets you want to trade. Okay, and then on top of that, we'll add more automation with auto climate and AutoUFOs, and of course, okay, of course. But let's start from the basic. Okay, so first of all, we have those products, okay, and they have certain characteristics. So which are the characteristics that I care the most about? Well, first is the expirations. Okay, first is the expirations. So remember, those products, for example, the S&P, they are futures. And because they are futures, they are contracts. And since they are contracts, they have an expiration date. And what's the thing with the expirations? Okay, well, the thing with the expirations is that some products have very few expiration dates or very few contracts or very few times a year you have the event of expiration, where other products have expirations that happen in a very, very, very regular basis, like every month. Okay, and if that was to be the case, then it creates a certain level of complication in your trading, because what you need to know about expirations, okay, something you need to know about expirations is that each expiration date is a different contract. Therefore, it's a different product. Therefore, it has a different symbol. Okay, so in other words, if you're trading crude oil, okay, which crude oil is CL, and crude oil has many, many expirations, let's say each month. So every month in your trade station, when you are loading the charts every month, again, if you were to use a very basic platform, TradeStation is more advanced and we have more flexibility there, but let's pretend you are using a very basic platform with basic functionality. So what would happen? Well, what would happen is that you would need to change the symbol every time every month. Like going to an extreme, let's say you trade stocks and you trade Microsoft. So Microsoft is MSFT and it's not going to change. It's going to be MSFT all the time. I mean, it could change if there is a company merger or something like that. But then it would change and it would stay like that for years and years and years. Right? That's it. Where futures would have new expirations and therefore new symbols, every time, expiration date takes place. So there are some markets that are very, very easy. For example, the S&P and the NASDAQ. And that's another reason why during this month we have been practicing with those markets, because I know that not everybody in the group is familiar enough with futures. And of course, if those products change symbol very often and you were to make a mistake with the symbol you use, next thing you know, you are buying or selling the wrong product, you may lose money. You don't even know you're losing money. So in order to make it simple, I started using S&P and NASDAQ, again, because they are very liquid, etc., but also because the symbols change only every 3 months. Because the S&P and the NASDAQ got 4 expirations per year. Okay? 4 expirations per year. That's it. Okay? Therefore, you need to change symbol 4 times a year, once per quarter. Okay? And we have been doing this together. I have been leading you into doing that when we have done the sessions. So, you change the symbol and then you keep it for 3 months. So if you were to make a mistake with the symbol, it happens every 3 months. So it's okay. Right? Where other markets, you need to change the symbol every month. So you could get distracted, and next thing you know, you are making a mistake, okay, because of that, okay? So now, so that's one thing you need to know, okay? And later, by the way, I'm giving you a basic explanation now, which I'm sure some of you know about this, okay? But if you don't, this is critical. And then the most important part is that I will show you how to deal with it in order to make your life simple and not to make mistakes with symbology, so you don't get in trouble just because you didn't type the right symbol, okay? So I will show you ways on how to erase that problem, and the problem is gone, okay? But for you to remove the problem, you need to understand there is a problem. If you don't understand there is a problem, then you would fall into a trap without knowing you are trapped, okay? So 4 expiration days per year, okay? Which means that we're gonna have 4 new symbols each year, okay? And because those symbols are gonna be new each year, so those symbols need to have something, okay, that points out at the month when the expiration takes place, and also something that points out at the year when the expiration takes place, okay? So how is the year being represented? Well, it depends on the platform that you use. Most platforms is going to be 1 digit. With TradeStation, it's going to be 2 digits. So for example, if the year is 19, with many platforms, it would be 9. Why? Because it's the last digit of 19. With TradeStation, it would be 19. Why? Because TradeStation uses 2 digits for the year, which, it's a little more complete, to be honest. And what about the month? Okay, well, if you're thinking it's going to be 1 for January, 2 for February, then you're wrong. It's not like that. Okay? The way expiration dates work in futures, and don't ask me why, because I never understood, but it's like this. Okay? Every month has a code. January is F, February is G, March H, April J, May K, June M, July N, August Q, September U, October V, November X, December Z or Z, depending if you use American English or British English. So that's how it is. And if you ask me why January is F, I have no idea. I never understood, and this is actually confusing, okay? But again, I want to give you little tricks. So if you are dealing with the S&P, which expire every 4 months, every 3 months, okay? This is gonna be March, from January to March. This is gonna be then June. This is gonna be then September, and then it's gonna be December, okay? So those are gonna be the expiration months, okay? So what is March? Well, March is H. What is June? Well, June is M. What is September? September is U. And what is December? December is Z. Okay? So what do you need to remember for the majority of futures markets? Okay? Because the S&P, the Nasdaq, the YM, the RTY, the TY, the FV, the US, the currencies, okay, and some of the agricultural, they have 4 expirations per year. Okay? So for all of those, okay, for all of those, the only thing you need to remember is H Muse. That's it. Just remember H Muse, and you are all set with those markets. Okay? So for example, let's say you are trading the S&P. Okay? So remember, S&P is ES. And then you are trading the December expiration. So it's Z. And it's December 19, 19. So what is the symbol? ESZ19. Done. Let's say you are trading the Nasdaq. So the Nasdaq is NQ. And you are trading the Nasdaq using September expiration. So then is U. And then is September expiration next year, 2020. So it would be NQU20. That would be the expiration date for next year, for September, for the Nasdaq, NQU20. Okay, and this is how you build your symbols. Okay, so for the majority of products that I have showed you a minute ago in the other slide, you only need to remember H Muse. That's what you need to remember. And by remembering this acronym, you know it's March, June, September, December. And if not, just print yourself this table. Okay, just Google, you can see the symbol here on the URL on the internet, cmegroup.com/monscos.html. You can print this to yourself, for yourself, just keep it next to the keyboard, and that's it, okay? But again, that's probably an easier way to remember, which is H Muse, okay? Now for other products, such as crude oil, that have expiration dates each month, then I don't know how to do it for you to remember all of this, okay? It's probably too long for you to remember FG, H, J, K, M, N, you know, it's confusing, okay? So then what I want to give you is a different approach to understand symbology for those other markets, okay? So you make sure that when you use the symbol, you use the right one, okay? Okay, so guys, please give me a little bit of confirmation. Again, I believe, I know some of you in the group have been trading futures for some time, so this is not new to you, but as a group, generally, I would like to make sure everybody's following, because for the ones of you that have not traded futures yet, this is probably looking a little, let's call it weird, even though it's very normal, but it may look a little weird if you've never seen it before. Okay, so how is it going? All good, very good, perfect, nice. Perfect. Okay. So now, so we have all those symbols, correct? We have all those symbols, but let me bring this here. We have all those symbols, okay? But you may not know which one to use. For example, when I told you about energies, and by the way, I'll talk about this website in a minute. This website can save your life, okay, when it comes to not making mistakes with futures trades, okay? So for example, let's say you're trading crude oil, which is CL, right? CL, as you know. So crude oil. So if I click on that link, and I'll talk about this website in a minute, notice what it says up here. CLV19, okay? CLV19. So what is CLV19? Well, CLV19, the V is the October expiration, and 19, it's 19. So what does it mean? Okay, well, what this means is that the people trading crude oil now, even though there are different contracts with different products that are tradable, okay, as we speak, the fact is that the one that is the most liquid, the one that the vast majority of people trade as we speak, is the one that expires in October. Okay, and you can see this, like in this website, you can see that very clearly. If you look at the V, okay, you can see the volume for this contract and the open interest, okay, is the greatest of all. If you were to look at the X expiration, which the X is November, okay, you would see that you have volume too. 100,000 contracts were traded, the other day, and you got open interest of 212,000. So people are trading those contracts, and the next contract, the Z and the F for January 20, and you got liquidity, you got contracts being traded for all those different contracts, because the people that buy those contracts, because they want a future delivery of crude oil, of course they pick the one with the date they want for the delivery, because it's futures. That's why it's called futures. So there is liquidity in all the expiration dates, but which one got the greatest liquidity? It's the V. Okay, and how do you know it's the V? Well, you know it's the V by either looking at the table and looking at the one with the greatest volume and open interest, or you know it's the V just by looking at the top of the website, which is the title of this page. Okay, and now you know it's the V. Okay, so again, how do you deal with markets such as S&P or NASDAQ? It's very easy, because they only change the symbol every 3 months. So right now, if we are trading the S&P or the NASDAQ, what are we trading? We're trading the ESU19. This is what we're trading. Or NQU19. This is what we're trading. And we will not change that until when it's time to change, which is the rollover date, which I'll need to talk about that. And when you change it, okay, you will then change it for ESZ19, NQZ19, and you will keep it like that for 3 months. So there is no need for you to come to a page like this and check this every month or every week. No need. But for contracts such as crude oil, okay, or gold, like take a look at gold, for example. So if I go back to futures, contract specifications, I look at metals, I look at gold, GC, gold contract, right? What does it say? GCZ19. So even though crude oil is trading, the majority of the trading is happening on the V, with gold, the majority of the trading is happening on the Z. Okay, and it's not like there is not a V, there is a V, but the V got little liquidity. Most of the liquidity is on the Z. So as a futures trader intraday, which one are you gonna trade? Hey Orlando, good to see you, my friend. Which one are you gonna trade as a futures intraday? You're gonna trade the Z, you will not trade the V, because you would put yourself in a low liquidity situation, opening up the door for slippage, bad fills, and problems, okay? So you're gonna be trading the Z, okay? And how do you know that? Again, it's either you look at manually at all the expiration dates and you look at the volume manually or stuff like that, or very simple, you come into this website, and that way you avoid making mistakes, okay? So let's talk about this website very quickly. This is a free website on the internet, by the way, okay? And I'll give you another trick as well on how to do this without even the website, okay? But not everybody uses TradeStation, so I want to give tools for everybody. So, let's say, what website is this? Okay, this is where I was going first. So this website is barchart.com. Okay, so you just go for www.barchart.com. Okay, they certainly have a premium type of membership here. No need. You can either subscribe for free if you want. Okay, they have a I am logged in here, so you can see my account, which means I am logged in as a user. But you can just subscribe to a free user or not subscribe at all, and then you can still click here on the future section, and you have under resources contract specifications. Okay, so that's the section I was using. Which, by the way, this section is also very nice to give you a tour of the different futures markets available. Okay, so you have the currencies, the energies, the financials, which I call treasuries, the grains, the indices, the meats, the metals, and the softs. Okay, now again, here you got all of them, the ones that are in the US, okay? There are more futures markets in Hong Kong, in Germany, in London, in many places. But those are the US markets, okay? But again, for example, Mexican peso futures. I mean, if you look at the liquidity of that, okay, and again, nothing against that currency, but technically speaking, for a trader to trade it, we need liquidity, right? So how many contracts you have? Yeah, it's nothing. Okay, very, very little. 42,000 contracts. That's nothing. Okay. So again, if you are a purchaser for a company and you need to hedge the price of a currency and you want to use those products, it's okay. You get physical delivery of currency in a future date, right? Take care, Shubhash. So you get physical delivery in a future date, and it's okay. But if you are doing this for you to make money trading intraday, like it's our case, then obviously we need to focus on the ones that are more liquid. Okay. So that's why, again, earlier I started giving you a tour using this page instead of the website. Okay. But it's a good to know. It's a good to have to know this website exists, because now when you want to trade a market, let's say for example you want to trade British pound and you never traded it before, so you can click on it, and next thing you know, it will tell you the right contract for you to trade is the U19. Okay, is the U19. And but by the way, as I told you, the currencies are like the equities. So if you trade the S&P and it's U19, you know the British pound is U19. Okay, so it's nothing new. Okay, but it's always good for confirmation purposes. Okay, now so first thing that we need to know about those futures markets is their expirations. And this is because the expirations will impact the symbols, okay? Expirations will impact the symbols to be used. And this is critical because using the wrong symbol, could put you in trouble, okay? So let's go a little deeper into understanding, in this case now with TradeStation, okay? So let me go ahead and open, for example, crude oil. Okay, so I'm opening crude oil here on TradeStation. I'm gonna have a setup here like you have seen before. I'm gonna have my 3 edge time frames. I'm gonna have my common time frame, and I will have my reactive time frames. Okay, so this is nothing new. This is what you guys know. Okay. It seems that I have a little problem with my internet connection, I would guess, because it says authenticating here for the auto climate. So yeah, so I may have to restart my TradeStation in a minute. But anyway, it doesn't matter. So what symbol I have here? At CLV19. You see that? Okay, so now let me explain something I explained already in the past. I could go ahead and use @CL, and if I was to use as @CL with nothing else, TradeStation would give me the same chart. Okay, TradeStation would give me the same chart. But the problem is that if I try to place an order with the matrix with @CL as a symbol, I will get errors because @CL, it's not a tradable symbol. A tradable symbol in futures requires, okay, the expiration date. So I got two options, okay? I could go ahead and use @CL, or I could go ahead and, knowing that in the world of energies, okay, in the world of energies, more specifically in the world of crude oil, knowing that the current symbol is CLV19, okay, so I could go ahead and instead of @CL, I could type CLV19. I could do that. And if I do that, it will load a chart, and the matrix will now allow me to place orders, okay? So notice how the 4 buttons are now colored, where if I was to use @CL, okay, I get the same charts, okay, but notice in the matrix, all the buttons are grayed out. Why? Because @CL is not a tradable symbol. CLV19 is a tradable symbol. But what's the problem? Well, the problem is that CLV19 is tradable, but it's a contract symbol that only shows you data for that contract since the date that contract was born until the day the contract expires, okay? But in futures, we got something called rollover, which I remember we talked about that in our sharpening sessions intraday. And what happens is that contracts overlap each other. So as you have seen clearly, okay, while the CLV19 is the most liquid contract, the CLVX19 also has trading going on. And by the way, while it's not happening right now as we speak, but there will be a day, which is the rollover date, when the CLX19 will get more liquidity than the CLV, and the CLV has not expired yet. It may have still 2 or 3 days to get into expiration date, and then you would have the CLV19 with less liquidity but still exist, and the CLX19 with more liquidity and exist as well. So then when it comes to charting, the question is, so which one should I chart? Should I chart the X or should I chart the V? Well, to place order, it would be clear that if we moved into the X with more liquidity, and here on the top it says X, you would need to trade using the X. But when it comes to loading a chart, okay, if you are looking at UFOs from the week before, maybe you would need to chart the V, and therefore it would be so complicated charting the V and but placing order on the X and vice versa, and it would be a mess, okay? So that's why trading platforms created the continuous symbols, which in this case is the @ So when you do the @ symbol, TradeStation automatically connects all those contracts, the X, the V, all those letters, they are all connected in an unlimited, timeless contract or symbol that gives you all the information about crude oil since the beginning of times. And most importantly, the information you see is when the contract was liquid, not when the contract was not liquid. So we love charting using continuous symbols because that's the way to go, okay? But again, I'm repeating myself, we cannot place orders with a continuous symbol. So you will need to use 2 symbols, one for charting, the continuous, and one to place orders, which is the CLV19, okay? So what has TradeStation done? Well, TradeStation allows you to merge it, okay? And if you were to use @CLV19, so in other words, you use CLV19, which is what the website told you, but you add the @ at the beginning. So what happens now? Now you end up with a continuous chart forever, okay? You end up with a continuous chart forever. But now on top of that, notice the buttons are colored on the matrix, which means that now the matrix understands you are trading on the V contract, even though there is an @ at the beginning, because you type V19, now the matrix knows which contract you want for the trades, and therefore you are now allowed to trade. And then it's very simple to use. You only have one symbol to use, @CLV19. That's it, done, okay? Now, what is the other benefit of doing this? Well, let's say, before the V, what did we have? Well, before the V, sorry, not here, here. So before the V, we had the U, okay? So let's say you were trading when the U was the most liquid, and then you went on vacation. And when you came back from vacation, the most liquid is the V, but you don't know yet because you just came back from vacation and you saved TradeStation with the U. So when you save your workspace, you were using the U. So what's the good news about using this type of nomenclature? Which is the other reason why I train you to do that. Okay, even though I never explained it before. Well, if you were to use @CLU19, okay, just because you got distracted because you didn't know the V is now the most liquid, okay? So notice what's happening. TradeStation is going to give you this very, very ugly chart, okay? It's going to give you this very, very ugly chart. And then somehow visually, you would realize, wait a minute, something's going on here, okay? And basically because, now you have less liquidity available, and therefore, the way the chart will look, especially the time chart, okay, because the shares and the ticks will kind of balance this out, but the time chart will look very, very ugly, and you would get to realize that, hey, something's going on here, okay? And even better, if you were to make a mistake now, you realize, hey, the U is over, I need to switch. And we are human. Sometimes we make mistakes, right? So after the U, it's time to go for the V. But let's say you got confused and now you're going for the X, just because it's a mistake. So what will happen if you use the X? CLX19, the moment you do that, look at what's happening. Okay, you get a request failed, incorrect symbol. It doesn't exist. So somehow, okay, what I'm trying to lead you into is to have a process for yourself where you minimize the possibility of a mistake using the wrong symbol. Because if you use the wrong symbol, you happen to trade the wrong contract. It may still be crude oil, but being a different expiration date, it's actually a different price. Take a look at the prices. Okay, the last price for the V is 55, where the last price for the X is 54, and the last price for the K is 52. So you would be filled at the price you think is good, but it's not good. It's just because it's a different contract, it's a different price, and now you get filled when it's not time to get filled. Okay? So again, I'm repeating myself, using the right symbol in futures is critical. And I have given you a few tips on how to help yourself to make sure you're using the right symbol. Let me repeat and summarize one more time before I go for the next characteristic. First, for the majority of the markets, it's 4 expirations a year. So the only thing you need to remember is HMUs. That's it. Just remember that, and it's very simple to switch symbol without getting confused. Second, even if you were to forget, or if you use markets such as crude oil, gold, markets that have more expirations per year, then it's impossible to memorize this table. So what is the way to do it? I mean, I'm not saying it's impossible, but it's certainly confusing. So what is the right way to do it? Well, one recommendation is to use bar chart, use their future section under contract specifications. Pick the market you want, for example, metals, and let's say you're gonna be trading copper, okay? So locate copper, and the moment you click on copper on the top, it will give you the symbol that is active at the moment, the most active symbol at the moment. So without even thinking, that's the symbol you use, HGZ19, okay? And to have a third level of confirmation and making sure you don't get in trouble, then when you use TradeStation, use that symbol with the at the beginning. So you get a continuous chart while you get execution capabilities on the matrix or the order bar or chart trading. However you execute in TradeStation, TradeStation will know how to use @CLV19 or whatever market you trade. Okay? So please, everybody, give me confirmation that you're with me up to this point, because this will lead into many more things, and I need to make sure this foundational information is well understood. Again, I know some of you already knew all of this, but I need to make sure the whole group is in the same page. So please, little confirmation here on the chat box. A quick okay, a quick good, we do. Wonderful. Perfect. Okay. So first thing that we need to know about those products is their characteristics. The first characteristic, as I said a few times already, is going to be the expiration date of those products, which is going to be different. Okay. So each month for crude oil, every one of those products is going to be different. What is the next characteristic that is key? Well, is the margin required for you to take those trades. Okay. Different products require more money to be traded than others. Going to an extreme, okay, we have the micros, okay, which require very, very little money, okay, very low margin, okay. So just to make sure we're on the same page, margin means the amount of money you need in your account to be allowed to take a trade per contract, okay, and to be allowed means that the broker allows you to do it, okay. In other words, if the S&P has a margin requirement of $7,000, let's say that's the case, but you only got $5,000 in the account and you want to take a trade with the S&P, you will get a rejected order in your account, and the reason why would be insufficient funds. Okay, and why is that? Well, because the broker told you 7,000, but you only got 5,000. Okay, so margin means amount of money that you need to be allowed to execute the trade. Okay, this is a simplistic definition of margin, but it's good enough. Orlando, I use this one for crude oil, which activates matrix and is a continuous chart. Yes. Well, you are using a continuous chart with on adjustments, okay? On adjustments, okay? That's what you're using, Orlando. When you use the ending, okay, because your ending is not at CLU19 as I just, V19 as I just suggested. Your ending is at CL V19 equal 103xn. Okay, and what this does in TradeStation is that it would force, when that continuous contract is being built, it would force for the rollover date is forced to be 3 days prior to expiration. Okay? You would be forced to do that. Okay? But what's the reality? The reality is that it's not always like that. Sometimes it's 2 days, sometimes it's 1 day, sometimes it's 4 days, sometimes it's 3 days. Yeah, the majority is 3 days, but not always. Okay? So I remember showing it to you and proving to you that CLV19 actually would give you better results than CLV equal 103xn. Okay? Again, in a theory world, and many years ago, and there are many people out there with all respects that are very old school traders that learn to trade on the floor, and they have beliefs based on those very old times, which are very valid in some aspects, but less valid in other aspects. Because one thing that has changed since those very, very old times and now is that now the king is computers. In the old times, the king were those people, those floor traders, okay? Now is computers. So what happens? The majority of computers nowadays are using at CLV19 without any on adjustment at the end, like 103xn. So a person who may have a very strong beliefs about how the markets used to work in the old times may prefer to use 103xn. And I'm not saying it's wrong, you will still have good results. But the reality is that when you look at stats, and you can do that very easily with AutoUFOs, isn't it? You will get better stats with CLV19 without the ending equal 103xn, okay? So my recommendation, no need to make your life complicated with the ending, even though it's not too complicated because TradeStation does it for you just by typing it. So it's not too complicated, but again, just do it if it gives you an edge. If it doesn't give you an edge, you know, so I would say no need. So go ahead and using the edge timeframes that you use, Orlando, load decent amount of data on your chart, look at the UFO stats, and then compare with the 103xn at the end, and you know, you decide for yourself, okay? In the sessions, you will see me use at CLV19 without the ending, because the king nowadays, the computers, not the floor traders like it used to be decades ago. This has changed, okay? So we need to be adaptable in the marketplace. Anyway, so what else? Okay, margin. Yes, we're talking about margin. So I'll delete this so we have a clear page in front of us. So margin, okay? So margin is the amount of money that your broker requires you to have in the account to be allowed to execute a trade, either long or short, on a specific contract, okay? So where can you see margins? Well, first of all, margins are recommended by the exchanges. Some brokers follow the recommendation, some brokers don't. So let's begin with the brokers that follow recommendations. And I will show you that, by the way. We'll talk about margin and then I'll give you a break, okay? So let's go back. Here we go. So for example, here for gold, okay, you can see the margin and the maintenance here is set as $4,950 of initial margin, $4,500 of maintenance margin, okay? So again, always look at the biggest value because that's the one you need to be allowed to enter the trade in the first place. So I would say, I mean, you can look at both, but you know, just to be very pragmatic, I'll look at the biggest one. So that's close to $5,000. So who says that? The exchanges. The exchanges publish, and those values, by the way, they change through time. And the exchanges will publish and they will say, hey, we require 5,000. We suggest you to, you broker, we require, let me rephrase all of this. The exchanges will tell the brokers, you brokers, we suggest that you require $4,950 to your customers to be allowed to take trades long or shorts per contract. So that's a recommendation. And normally, brokers follow through. Okay? So if I bring TradeStation and I look at menu and I look at pricing and I look at futures and I look at C details and I look at futures margin requirements and I look at crude oil, sorry, at gold, here we go, 4,950 of initial margin and 4,500 of maintenance margin, which is 100% exactly the same as what we have here on bar chart, which is the exchange recommendation. So as you can see, many brokers, especially high reputation brokers, will have the tendency to follow what the exchanges suggest. Now, the biggest risk in futures, actually the biggest risk in all markets, no matter the market, is when the market closes. Because when the market closes and then reopens, you may have a gap. And the futures, okay, most of the futures markets, they only close 1 hour a day. Some, especially the agricultural products, they may close more than that, but the majority is 1 hour a day. So 1 hour a day, you may not have a big gap. I mean, over the weekend, maybe bigger. But still, if you have a gap on futures, and you all know that when we trade futures, we trade on leverage. Let's say the leverage is 100 to 1. So if you have a gap and you get hurt on a gap, and whatever the gap is, let's say the gap is 1%, but you lose 1% on 100 to 1 leverage, that means you lost 100%. So that's a lot, right? So because of that, okay, that margin required, and definitely the maintenance margin, has a lot to do with the perception that the exchanges have when it comes to volatility risk. And the more crazy a market is, the more they require, okay, for example, palladium, okay, is less liquid, and because it's less liquid, it's crazier, and because it's crazier, they require $14,000, which is more than $4,950. Okay, so this is again the recommendation from the exchange. Again, most reputable brokers follow through. But then, if you happen to trade those markets intraday only, okay, normally, not all products, but for the products that are more liquid, they give you an extra benefit, okay, which is what you see here in TradeStation in the column on the right, which is 50% of the initial. What does that mean? See, if I go on the top of the column here, it says day trading rate. So how much is the day trading rate? Well, for gold is 50% of the initial margin. So the initial margin being 4,950, 50% of that is divided by 2. So that means that the amount of money that you will need to have in your account to be able to take gold trades intraday, it's $2,475 per contract. If you want to trade 1, you need that. If you want to trade 2, you need double. That's what you need in the account to be allowed to take the trade. Okay? Again, you have a little bit of a discount or benefit given by the broker if you are out of the trade before the risk of gap, which is 5 p.m. Eastern time. You get out before that time, and you are being charged, or you need $2,475 in your account. If you were to exceed that, or the broker was not to give you that benefit of day trading rate, which some brokers don't, then you would need full $4,950 per contract to be allowed to take the trade long or short. That's called margin. Okay? Not all brokers are like that. Okay? Especially for the very liquid contracts. For example, the S&P is probably the most liquid contract in the planet. So the broker gives you more benefit. So the initial margin is 6,930, which again, let me go back to bar chart and look at indices and find the S&P. Okay, I just clicked on it. I should have not clicked on it. Let me go back. So when you look at the S&P, notice that the recommendation of the exchange is 6,930. You see that? That's the recommendation. Well, guess what? That's exactly what TradeStation gives you. Again, I told you that majority of, especially reputable brokers, they follow that. Okay, but again, TradeStation now for intraday, instead of requiring you to have half of it, which is 0.5%, 0.5, they only require 25%, as you can see on the column on the right, which is $1,732. So as long as you got $1,732 in your account, you can take the trade long or short per contract. Again, this is the classical scenario, especially among reputable brokers. The more liquid a market is, the more benefit they give you intraday. Okay, the less it is, the less benefit they give you. And if it's not too liquid, they don't give you any benefit. You just need to come up with a full initial margin. Okay, if you use other brokers, typically smaller companies. Okay, and I'm not saying they are bad companies, but companies that are more eager to have customers. So for example, here I'm looking at GFF brokers, just to pick one. So notice that for very liquid contracts, such as the S&P, okay, they have the same parameters of initial margin and maintenance margin, but for intraday, you only need to come up with $500 instead of $1,732 that TradeStation would ask you. Why is that? Well, this is because that broker is probably, I was going to use the word desperate, probably desperate is the wrong word, but they are very, very eager to get customers, and this is how they make it attractive for new customers to join them. In other words, you are dealing with a smaller broker, a smaller firm, so now you get a little bit into risk of broker bankruptcy, and I'm not saying that's the case of GFF brokers. Maybe they're a good one, but you know, you do have a little bit more risk compared to brokers such as TradeStation, where they give you benefits, but you know, not that crazy, the benefit, which in one hand is very appealing, but of course, like everything in life, more reward equals more risk. Okay, so you need to keep that in mind. Okay, so again, margin may be a reason for you to decide to trade markets and to decide to ignore markets. For example, with crude oil, we said that you need around 5,000, where with the S&P, we said that you need around 2,000, 1,700 something, right? So actually for crude oil, it was half of that, so it's 2,500, okay? So again, those different values may dictate which markets to trade or which markets you don't. For example, let's say you tell me, I want to trade the DAX. They have told me this is an amazing market, which by the way it is. Okay, well, how much you need to trade the DAX? Well, to trade the DAX, you will need 19,000 euros per contract, and you only need 25% of that. Okay, but how much is that? Well, 19,500 euros. If I convert that into US dollars, which the US dollar is 1.1 more or less, so that's $21,000. And yes, you only need 25% of that. So that means that you need $5,500 to trade the DAX. So in this comparison table, now you need $5,500 per contract to trade the DAX instead of $2,000 only to trade the S&P. And yes, the DAX is more volatile, so maybe it's worth it. Okay, it moves more every day, so maybe it's worth it. But maybe that capital, you don't have it, or maybe you do, right? So as I said at the beginning, the characteristics of those products dictates if you should use those products or you should not. Okay. Another very important, oh, by the way, I said I will give you a break. So let me give you a break now. And when we come back, we'll continue with this, okay? So guys, just two things. Please type on the chat box if everything is going well, a quick okay or good or yes, we do. And I will see you in 5 minutes. I'll be reading your answers and we'll restart in 5, okay? So break, 5-minute break. Hey everyone, this is Jose. We are restarting in just a few seconds. Please give me a confirmation that you hear my voice. This is a sound check. Quick confirmation, please. Okay, wonderful. Thanks everyone. So we are restarting, okay? So again, looking at those characteristics, right? So we have the expirations and we have the margin, okay? The next one that we need to discuss is the volatility, okay? In other words, if you were to pick a futures market that doesn't move at all, that is not gonna help you to make intraday profits. Where if you were to use a market that moves nicely, then that would allow you to create certain level of consistency when it comes to making profits every single day you load a chart, okay? So we want certain level of volatility. But there is also something that comes together with the volatility, which is key to understand. It goes together, you cannot detach it, which is the point value, okay? Every futures markets have a different point value. The volatility by itself says nothing. The volatility combined with the point value tells you how much can you make per day, okay? So take a look at this. If I load, let me load a chart from scratch. So if I load a chart, okay, so here's a chart, okay, and so this is the daily time frame of the crude oil, perfect, okay? And what I'm gonna do is I will add study, and I want to add the average true range, okay, average true range. So I get to see from a volatility point of view, I get to measure how much as an average that market moves every single day. And you can see that the average, at least for now, is 198. In other words, every single day, this market moves either up or down an average of 1.98 points. If I was to look at the S&P, okay, and again, looking at volatility calculations, as an average, okay, this market has been moving at a rate of 55 points per day, okay, which this is quite spectacular. This is not normal, if you wish, compared to other times where, you know, it may be moving at a rate of 20 points, something like that, okay? But now, of course, when the market is collapsing like crazy, volatility rises, right? So maybe actually a better way to understand volatility would be just to draw a line, you know, somewhere in the middle, and it's 37 instead of 55. But it's okay, just to keep it simple, let's call it 55. So if you look at the S&P moving 55 points a day, and you compare that with crude oil that moves 1 point per day, okay, maybe you would say, you know, maybe you would say that, you know, oh my God, why would I even trade crude oil? What a waste of time. Trading the S&P is way better. The market moves 55 times more every single day, right? So that would be much better. Or for example, if you were to look at the NASDAQ NQU19, okay, so the NASDAQ is moving an average of, okay, it's loading. I think this is the time, and this happens to us before, isn't it? This is the time where TradeStation is doing some maintenance behind the scenes, and next thing you know, it's taking forever to load those charts. Look at that, NASDAQ, 176 points every single day. Oh, what about the Dow Jones, the YM? So YMU19, okay? So if I load the YM, you know, so we got crude oil, 1.98, we got the S&P 55, we got the NASDAQ 100 plus. So what's gonna happen with the Dow Jones now? Okay, so it's loading. I guess we'll have the chart on the screen very, very quickly. But basically, so what I'm about to say is that we're gonna have a huge value now. And here we go, 489 points per day. And basically you could say, you know what? I'm just gonna trade Dow Jones only. I'm just gonna forget about everything. I just need to take one trade per day, and I will be millionaire in 3 days from now, right? And of course, I'm using a little humor here. But that would be a totally wrong understanding of what's going on, okay? Because, yes, it's true that, if I add the Dow Jones here, which is the YM, so volatility-wise, we got, 400 plus points a day, the Nasdaq 100 plus points a day, the S&P 50 plus points a day, where crude oil was 2 points a day, 1.98, I'll call it 2, right? And looking at the figures like that, you would be like, oh, this is a no-brainer. Okay, I'm just gonna trade the Dow Jones, done. Okay, well, that's why point value is very important. Because yes, it's true that the YM moves more points per day, but the question is, how much is a point on the YM? Well, 1 point on the YM is $5. Okay, and I'll show you where to find that information from in a second. I know it by heart, so I'm just sharing with you. Okay, how much is 1 point with crude oil? Well, is 1,000. How much is 1 point on the Nasdaq? Is 20. How much is 1 point on the S&P? Is 50. So if you were to now take the amount of points that this market moves, multiply times how much is a point value, that would tell you that a daily move on the S&P may pay you $2,500 per day per contract, if you were to catch the whole move, of course. Okay, which we're not going to do that. We'll catch a portion of it, and that's going to be good enough. But if you were to catch the whole thing, it would pay you $2,500. What about the Nasdaq? $2,000. What about the Dow Jones? $2,000. What about crude oil? $2,000. So notice that even though those markets show very different volatility values, the fact is that when you multiply these times the point value, now you get a better feel for what's worth it and what's not. For example, a market that since some time ago has been, a little bit in the boring side, and it doesn't mean it's a bad market. It means that things change in the market. Markets that are volatile become slow pace, and markets that are slow pace become volatile. But one market that have not been very exciting in recent times is the euro, okay, which is a market that I personally love to trade. But in the recent times, we gotta face it, it's been much less volatile compared to other markets. And again, by the way, this will change. When? No idea. But when it changes, we'll know, and then we'll trade accordingly. So the S&P has been moving at a rate of 0.05500. Okay, so this has been for the S&P. You know what? I'm just gonna have the S&P here, just to compare them all together. So 0.0055, okay, and the two zeros in the end is not helping, so 0.0055, okay, and the point value for this market, okay. By the way, I think it's a good time now to show you where to get those point values easily. Okay, I kind of showed you already, bar chart. Okay, so what is the point value for crude oil? You click on energy. You look at crude oil, and here on the right it says point value 1,000. What is the point value for indices? The S&P is here. What is the point value? 50. I mean, I know it by heart, but if you don't know it and you want to check, here's probably the best place to find all the information you need very quickly. So what about the euro? Well, the euro is here. Euro FX. Oh, Euro FX, and how much is the point value? $125,000. That's the point value. So if the point value is $125,000, that means that the amount of money you are likely to make per day is 687.5. Is that bad? No, it's not bad. But would it be more interesting to trade crude oil? Probably yes. It's a market that tends to move more. Okay? Tends to move more. So crude oil tends to move more. So you have more money to make. Now, having said that, the other question to be answered is, but how much money you need to make that potential $2,000? Okay, now we are back to margin. Okay, we are back to margin. So how do you know what's the margin? Well, you need to look at the website of your broker. Let's say you're using TradeStation. Okay, if you're using the S&P, we did the math already. You need 25% of 7,000. So 7,000 times 0.25. This is like 1,750. If you do the NASDAQ, it's 25% of 8,000, let's call it 500. So 8,500 times 0.25. I'm just rounding up a little bit. Okay, that's 2,125 with the YM. Okay, let me complete the table since we are doing it. Let's do it right. Okay, so with the YM, what is the amount of money you need? You need, where are you, Dow Jones? Right here. So 25% of 6,000. Okay, so let's call it 6,100. 25%. That is 1,500. Okay, with the crude oil, where are you, crude oil? Right here, it's 4,000 per contract, but you got 50%. So I'll call it 4,100 times 0.5. That's 2,000. For the euro currencies, right here, you need 2,200, but you need 50%. So I'll do 2,500 times 0.5. That is 1,250. Okay. So let me make this look a little better using the same dollar value there, so everything looks good. Okay. So in other words, for you to make 2,500, okay, you need to come up with 1,750. Okay. So that's the number. I'm using a basic division, right? So if I do the same calculation for all, so which is the market, okay, that produces the worst result? Well, it's the euro. Even though you need less money to take the trade, given the current level of volatility, this is the market paying you the least. Which is the market paying you the best? Well, it's actually the S&P. Okay, given the current level of volatility, okay, and given the amount of money that you need to take the trade, this is the market paying you the more. Now, these things change. Okay, sometime from now, the euro may be moving at a rate of 120 pips per day, and the S&P may be moving at a rate of 18 points per day. And now, who is the one paying you the most? Is the euro. So these things change. But it's important to have this type of a table where you are looking at the characteristics of those different products so you know which ones to trade. Okay? Sometimes I hear people that say, I love crude oil. I do love crude oil myself. But the right way to say it would be, I love crude oil when crude oil is volatile. That would be the right way to say it. Because there are times where crude oil, to be honest, not for too long because it's a pretty volatile market by nature, but these things may change, okay? And there are times where crude oil becomes quiet, and you never know, but maybe during the next 2 years, crude oil will be the most boring market in the world. We never know. So the beauty is that with futures, we have an easy way to change the markets that we trade to other markets that, given their current characteristics, provide us with better benefits, okay? So you need to have a way to measure that, okay? And the way to measure that, well, we went over together. It's look at the margins, look at the volatility and the point values, and I show you where to get all of it. Okay? To get the volatility, you just use a basic average true range calculation. To look at the point values, you can just use barchart.com. Okay? And the margins, now you need to look at the website of your broker. And now you do a simple calculation on a spreadsheet and you know what to do. You know what to expect. Okay? How is it going so far, everyone? You guys with me on that? Okay, so you could run this type of analysis, and I would suggest that you do it yourself. You take your time, because by running this analysis and doing it manually, it will get you properly introduced to our friends. And by being properly introduced to our friends, all those futures markets right here, you will now become very well aware of the markets that you want to trade and the markets that you want to ignore. Okay? So now, having said all of that, in my TradeStation, I want to show you something I've done, just in case you want to replicate it yourself. my matrix had changed symbol. I just wanted to force the right symbol to be. So what I have done here is that I have created a workspace with AutoClimate running on different markets. Okay, the two radar screens on the right are Forex. You can see I got majors in the middle, and I got minors on the right. Okay, but I will not talk about this today because today we are talking about futures. So I would like you to focus on the table I have on the left. And the table I have on the left, I have a collection of markets which are the ones that in current date I like the most for my trades. And how do I know that? Well, look a little bit more on the right what I have done here. So TradeStation, and I'm going to do this slowly so you see it. And if you want to replicate this for yourself, then you can just play the video, play and pause, so you can replicate what I'm about to do. But basically, if you were to insert study in your radar screen, and you were to shoot for custom study, okay? So you may have noticed that this is custom, this is custom, this is custom, and this is custom. Okay, you may have noticed that I've done that. So this is because I went to look for custom, okay, custom one line, and I have added 4 times custom one line, custom one line, custom one line, and custom one line. And what did I do? Let's begin with the last one. The last one, which is this column. So what did I do in this column? Well, if you click on customize, and again, if I'm going too fast, please play the recording once it's posted on the YouTube channel so you can play and pause. But basically, the custom indicator allows you to type whatever you want in the formula space. So what did I type? I just type volume day parentheses 1. And what is this showing me? This is showing me the volume from the prior day in a daily time frame. Okay, in a daily time frame. Why? Because if you look at my radar screen, okay, I'm running AutoClimate in the 15-minute time frame for NASDAQ, gold, euro, crude oil, and the S&P. But then I'm running AutoClimate for the 60-minute time frame from the natural gas and the yen. And then I'm running AutoClimate right here for the 4-hour time frame for lean hogs. Okay, and I want to know more about the liquidity of those markets, but I don't want to look at the volume in the last 15 minutes. I want to look at the volume in the last 1 day. So how did I do that? Okay, well, you can right-click, study, edit that column, and when you do that, in the formula you type volume day parentheses 1, and this is going to show you the daily volume from the prior day. So what happened in the prior day? NASDAQ got 422,000 contracts traded, the S&P 1.3 million. So you get to see the liquidity of those products. Okay, you can see that some products like lean hogs have very little volume. Again, Monday is a holiday, so not a surprise. But again, this is just for you to keep an eye on markets that may be losing liquidity. If that was the case, so let's say the crude oil was to lose liquidity. I don't think it's going to happen anytime soon, but you could go ahead and take it out. I mean, I remember not too long ago, like 1 or 2 years ago, the crude oil got like maybe 400,000 contracts per day, where now it's 600,000. So this is a market that became more liquid in recent times. That's good from the safety point of view, but normally the more liquid a market is, the less volatile it is as well. So, so again, you just keep an eye on this column so you get to know your markets, okay? And this, if you wish, this may be another column to be added here, which is the liquidity, okay? Which is the liquidity. You can look at that if you wish, even though all the markets that you have in this list would be okay, okay? But within okay, you got some that are better than others, okay? So this is a column for you to keep an eye, and because TradeStation, no platform got a column to do that in a 15-minute time frame, show you the daily volume. So you would do it by inserting the custom indicator and then use this customized formula, volume day 1. For the next one, okay, the next column, what I have, if I edit the column, notice that if I edit, the whole thing is blank. What does that mean? Well, it means that everyone has a different value. Here, when I right-click, study, edit, okay, I got something written next to formula. What does that mean? That this formula actually applies to all the rows. So you got something. But when every row has something different, then that's when, again, right-click, study, edit custom, that's when it would show as empty. Okay? So what do you do? Okay, so what do you do? What did I do? Then you just go in the column you want and you just double click. Okay, you just double click. So what did I type here? Well, I type a little bit of a fancy formula. High D, parenthesis 1, minus low D, parenthesis 1. So what does that do? This is calculating from yesterday daily candle. It's looking at what is the distance, what is the difference between the high and the low. Sorry, guys. So in other words, it's showing you what was the volatility yesterday. What was the range that was traded yesterday, from high to low yesterday. And then that number is divided by the tick value, okay? Not the point value, but the tick value. It could be okay as well with the tick value, with the point value, okay? But so instead of using the point value, I'm using the tick value, which is 0.0005. Well, in this case, it was, what was it? It was the NASDAQ. So if I look at the NASDAQ, here's the NASDAQ, okay? And, oh, I just clicked on it again. It's just like the habit. Here we go. So here's the NASDAQ, and the NASDAQ got a tick value of 0.25, and every tick is worth 5, okay? Which, again, 0.25 times 4 is 1 point, and 1 point is 20, which 20 is 4 times 5. So it's the same thing, okay? But again, in this case, I'm just using ticks, okay? So 0.25, okay? And what I'm doing is I'm taking the range from yesterday divided by 0.25. In other words, how many ticks were traded yesterday? And how much is a tick? $5. So I multiply it times 5. In other words, that value, it's similar to what I've done in the spreadsheet. Okay? I'm getting somehow a measurement that tells me how much money was possible to have made yesterday on the NASDAQ if you have traded the whole range, which that, by the way, it's impossible. But just to have a reference, what's the most you could have made yesterday by trading the whole range on the NASDAQ? Okay, and that way, I have a way to measure, a very visual, the volatility times the point value in a way that keeps updating every day. Okay, that keeps updating every day in a column on radar screen. Okay, again, I could do this better in a daily time frame radar screen, but I don't want to have 25 radar screens on my screen. I just want one. And because the one I'm using is 15 minutes, so I need to use those formulas to have TradeStation show me what I need. What else do I have? Well, I have another column here. And what is that column? Well, this column represents the margin. So what do? Double click, and here I type a value, 2,200. Click OK. Okay? And this is the margin. Okay? And again, those values are rounded up. Okay? This is what TradeStation shows on the website. Everything has been rounded up. I don't need to be precise here, just to have a feel. Okay? So by looking at this column, out of all the markets I trade, I know which ones are the cheapest ones. Which one is the cheapest one? Natural gas. Okay? But how much money can I make with natural gas? 500. Okay? Which one is the next cheapest one? 1,200. The euro. How much money can you make yesterday? 1,000 bucks. Okay? So you get to see that comparison that here I did very elegantly with percentages and stuff in the spreadsheet. Well, with radar screen, it's not a spreadsheet, so, but at least you get a feel for what's going on as things change in a daily basis. So if a market is becoming more liquid, less liquid, if a market is becoming more volatile, less volatile, you'll get to see those values change. And if you are trading those markets every day, well, believe me, those values stick in your brain, right? Because you see them every day, okay? And then finally, What do I have in the next column? Well, I have the tick values. The NASDAQ has a tick value of 5. So again, I'm using the custom indicator so I can insert it and then double click and just typing 5. It's nothing fancy, but it's very convenient because now when I'm looking at my auto climate, okay, and let's say I'm planning a trade on the NASDAQ that is giving me a near sensible short, the moment I am about to place an order, I know I will need $2,200 per contract to execute a trade. And I know that if the distance from entry to stop is 10 points, right? So my risk will be $200 because every tick is 5, so every point is 20, correct? And if my risk is 10 points, times 20 is $200. And I know exactly how much I'm risking, okay? So this column is a little bit of a reminder of what it is, which by the way, again, as you trade, you know those values by heart. You don't even need to check. But as you guys are adding new markets to your trading, you will not know it by heart. So to avoid errors while you are internalizing this information until it becomes second nature, so it could be quite handy that you replicate what I have done in my radar screen in yours. How is it going, guys? Please give me a little bit of feedback of how this is helping you. How is it going? Did I go too fast? Did I go too slow? Again, if it's TradeStation stuff, probably I went a little too fast, but you can then play and pause with the recording, so I guess that's fine. But everything else, is that making sense? Okay, because some people out there just trade S&P just because, you know, they heard it on TV. Or some people only trade the euro because my friend trades the euro. Okay, so my point is that I would like you to have a measurable way, as I said at the very beginning of the session, you have a measurable way to help yourself understand which markets are the healthiest for you, the ones that are more likely to provide what you want. And if anything changes in the marketplace, a market becomes very, very volatile or not volatile at all, then you could substitute the market by another one in a way that is measurable again. Yes, this will work in 9.5. You can replicate the same Orlando, no issues. Okay, so, and what's next? Okay, because we are, believe it or not, we're getting close to the end of the session. So what's next? Well, then I got my auto climate running with my alerts, okay? I will not explain today auto climate because we did a session on that a few weeks ago. So you can go ahead and watch the recording if you missed it. But what I did is, you know, I right click my auto climate for futures. Again, I'm dealing with the one on the left because the ones on the right is Forex. And today we're talking about futures. So you can edit auto climate. And what I have done is I have set up an alert to be alerted once per bar interval. Clear triggered alert on bar close. And I'm using my global messaging preferences where what I have done is to have a beep. And apart from the beep, I got a pop-up window. Let me change that one because that one I want it to be always open. Okay. So in other words, if any of those trades trigger one of those golden color alerts, I will not only have the alert on the radar screen, but if I happen to be looking at my email, if I happen to be looking at another screen, if I happen to be looking at a chart, another radar screen, I will have a pop-up window that shows up and sticks on my screen until I manually close that pop-up window. And that way, you know, it will lower the probability of me missing a trade just because I was not paying attention. So for example, now it seems that there is an opportunity with the NASDAQ, okay, for a sensible short. So what would I do? I would just go ahead. And the best way to do this is with multiple monitors. When I'm conducting the session for you guys, I'm only sharing one screen, right? So notice how I have all my workspaces ready here. Okay, so I will be using the NQ15, double click on it, okay, and that workspace will load with the typical setup with my common time frame and my edge time frames and my matrix, so I can go ahead and plan the trade, you know, and execute. Here is my climate with 2 candles into the climate. Exactly the information I got on the red screen is right here, and I have been alerted of this potential setup to be confirmed with AutoUFOs. Of course, without AutoUFOs, as you all know, that would be incomplete, okay? Well, not only AutoUFOs, and the process, correct? All together, okay? That is how you do it, okay? And the last comment I would like to add before we conclude the session is, notice how I am using 15-minute time frame with the Nasdaq, gold, euro, crude oil, and S&P. Why? Because good volatility, good volume, good margins, good everything. But for the natural gas and the yen, I use the 60, and for lean hogs, I use the 240. Okay, and what does that mean? Well, let me bring lean hogs, for example. So if I open lean hogs, okay, again, same setup, same everything, but what has changed? Well, first, okay, it's loading. So first, the common time frame is 4 hours. That's one difference. Okay. Second, the edge time frame is 21. Okay. By the way, I'm not using the right symbol here. I'm just noticing I made a human error mistake. So let's move into meat. Let's look at the lean hogs. Click on it. And the current symbol will be V19. Okay, V19. So I'm just gonna go for at LHV19. Here we go. And now I will have a tradable symbol. It's gonna be the same chart, but I will have a tradable symbol on my screen, okay? So anyway, so what do I have? I have the 4-hour time frame for common, I have the 21-minute time frame for edge, and then I have 610 share bar, 377, which is exactly what I have when looking at lean hogs, which is right here, right? For the 240-minute common time frame and the 21-minute edge time frame, I also use 610 and 377. And then for reactive, 149.89. Okay? So now, why is it that if I go back to my climates, why is it that for lean hogs I'm using 240? Because, I mean, it's nice, lean hog is 2,500, this thing, could make 670, so it's similar to Japanese yen, natural gas. It's a little less than the euro, so it's not super amazing, but it's okay, and it's definitely diverse, okay? It's not an equity, it's not a currency, so, I'm adding diversity, which is always good, but at the same time, why is it that I'm using 240 instead of 15? Well, again, that has to do with liquidity conditions, okay? So if I look at lean hogs for the 15 common time frame, lean hogs for the 15-minute time frame, here we go. So what do we have? 34, 21, 8, and 5. Okay, so my friends, let me show you how a 2-minute time frame looks for lean hogs. Okay, and again, this is just a matter of liquidity. Okay, so those candles are pretty terrible. Okay, how does the 21 tick candle look like? So if I come in here and instead of 377 I do 21. Okay, so I mean, I'm not saying you cannot use it, but these type of candles where you see a lot of wicking up and down, and many things that are not totally clear, all of this has a lot to do with lack of liquidity, okay? And again, you can see it here as well, where lean hogs had 16,000 contracts, which is so much less compared to the ones on the top. You can also see the ones I use with the 60-minute time frame have more liquidity than lean hogs, 100,000 instead of 16,000, but much less than 1,600,000, 200, 400. much less, right? So what do? Well, the less liquidity, it is recommended to use a little bit of a larger time frame, still intraday, a little bit of a larger time frame. So you are trading out of the 21-minute time frame with a 4-hour common, or you're trading out of the 8-minute time frame with a 60 as a common. And then for those that are very liquid, now you can be even more active with the 2-minute time frame and the 15-minute time frame as a common time frame. Okay. So again, this changes through time, not too much, not too often, but it may changes through time. And that's why it's quite handy to have those columns on the right to be aware when these changes happen, for you to review like once a week, something like that. Okay. So this is the list. You're right, Frank. So this is the list that starting from now on, I will be utilizing every time we do short-term trading with futures. I will be using this list and using the alerts. And while we have no alerts, I will not even be looking at the chart. I will be doing Forex. And while we have alerts, then I will go back to the futures and plan trades then, because I will have my pop-up windows show up on the screen. Okay? So I will save time. I will stack more probabilities in my favor. I will add more diversity, but this can only be done now that we had today's conversation, because it's been a lot of information for me to share for you to understand why you trade the markets you trade. Okay. So anyway, this is today's session, my friends. This is what I wanted to introduce you to. So that way, starting next week, I believe it's on Tuesday. Sorry, probably Wednesday, sorry. So starting next Wednesday, let me bring the calendar. By the way, it's always healthy that we look at the calendar all together. Okay. So this is what we're gonna start doing into next week, which is gonna be a much complete, if you wish, or richer way on how to do it more efficient. We are likely to find more opportunities, or the ones we find to be of a higher probability. Use our time more wisely thanks to technology. So yeah. Actually it's Monday. I was totally confused. Okay, so I'll see you on Monday at 9 a.m. to do short-term trading, and we'll be doing this on Monday. Okay, so perfect. And by the way, we have also added all the vitamin T sessions for the month of September. Notice that during the month of August, we were touching on TradingView. During the month of September, Brian will be touching on TradeStation and getting deeper into basics, okay? Age and common timeframes, risk management, more risk management. So, many important components and concepts, many of those pills for you to make sure that you have that regular intake of vitamin T, okay? So anyway, guys, super pleasure as always to spend a session with you. Super appreciated when you guys, super appreciated all the time when you join us, but on the weekend I understand that it's also family time and other responsibilities that you may have. So even more appreciated when you guys make the time to join us, because this is key for us to have smooth, easy to go sessions during the weekdays. And I really appreciate that. Because that way the sessions go smooth. Okay, so thanks a lot. Enjoy the rest of the weekend. Keep up the good work as always. Okay, and see you on Monday. Bye everyone.